On December 10, 2008, a man who controlled more money than most banks on Earth sat in a palatial Manhattan apartment and made a quiet confession to his sons. Outside, the world was screaming. The global economy was in a freefall not seen since the Great Depression. But inside that room, the air was still. Bernie Madoff looked at his two sons, Mark and Andrew, and uttered 5 words that would shatter the financial world. It's all one big lie. For decades, the richest families in the world trusted him. Governments trusted him. Charities, banks, and Nobel Prize winners trusted him. He was a former chairman of the Nasdaq, a pillar of Wall Street, and a man whose reputation was so clean that no one dared to question his methods. Beneath the tailored suits and the steady, legendary returns, nothing was real. This is the story of Bernard Madoff, and how the largest financial fraud in history didn't collapse because of regulators, journalists, or whistleblowers. It collapsed because he finally ran out of new money. To understand the fraud, you have to understand the man. Bernie Madoff did not look like a criminal. He was calm, soft-spoken, and reliable. Born in Queens, Madoff built his firm slowly, starting in the 1960s with $5,000 he earned as a lifeguard. He was a market maker, a middleman who helped the gears of the stock market turn. While the big boys on the New York Stock Exchange were still shouting on floorboards, Bernie was pushing for computers. He was a pioneer who helped build the electronic plumbing that eventually became the Nasdaq. By the 1990s, he was a giant. But while his legitimate trading business was booming, he started a side venture, investment advising. This is where the Madoff mystery begins. Bernie didn't use a marketing team or flashy commercials. He used scarcity. If you asked Bernie to manage your money, he might say no. He'd tell you he was full. This created a frenzy. Country clubs from Florida to the French Riviera became breeding grounds for his feeder funds. People would beg their friends for an introduction, desperate to be allowed into the inner circle. He wasn't selling returns, he was selling exclusivity. If you were in with Bernie, you were part of the elite. Madoff's sales pitch was a strategy called split strike conversion. In theory, he bought blue-chip stocks and hedged them with options to limit losses. It sounded sophisticated, it sounded safe, but the math was a fantasy. Madoff's returns were legendary not because they were massive, but because they were consistent. In a world where the S&P 500 swings wildly, Madoff's performance chart looked like a perfectly straight line angled at 45 degrees. If the market went up 20%, Bernie gave you 12%. If the market crashed 20%, Bernie still gave you 12%. In the real world of finance, that is a physical impossibility. It's the equivalent of a gambler going to a casino and winning every single hand for 20 years without fail. A few analysts tried to replicate his strategy using historical data, and they all came to the same conclusion: it couldn't be done. But when people asked questions, Bernie would threaten to kick them out, and because the money appeared to be real, everyone stayed silent. The secret of the 17th floor. While the legitimate side of his business operated on the 18th and 19th floors of the Lipstick Building in Manhattan, the fraud lived on the 17th floor. This was the engine room of the lie. Access was restricted. Even Bernie's sons, who worked for the firm, were never allowed to see the books on the 17th floor. While the rest of the firm used state-of-the-art computers, the 17th floor used outdated IBM AS/400 servers from the 1980s. This wasn't because Bernie was old-fashioned. It was because old tech is much harder to audit. There were no real trades happening here. Instead, a small team of loyal employees, many with no financial training, spent their days backdating trades. They would look at what a stock did yesterday, find the lowest price point, and print a statement saying they had bought it at exactly that moment. It was a factory of fiction. They weren't investing the money. When client A wanted to withdraw $10 million, Bernie didn't sell stocks. He just took the $10 million that client B had deposited that morning and handed it over. As long as more money was coming in than going out, the illusion held. But by the late 2000s, Bernie was managing billions, and the weight of the lie was becoming unbearable.
This brings us to Harry Markopolos, a math-obsessed analyst at a competing firm. In 1999, his bosses asked him to figure out Madoff's secret so they could copy it. Markopolos sat down with the numbers, and within 4 hours, he knew it was a fraud. He famously stated, "The math just doesn't work." Markopolos became a one-man crusader. He sent a detailed report to the SEC titled, "The World's Largest Hedge Fund is a Fraud." He pointed out that for Madoff to be making the trades he claimed, he would have had to buy more options than actually existed on the entire Chicago Board Options Exchange. He literally proved that Bernie was claiming to buy things that didn't exist. The SEC investigated Madoff multiple times. They interviewed him. But Bernie, the former Nasdaq chairman, charmed them. He gave them fake account numbers and technical jargon that confused the junior investigators. They were so intimidated by his status that they didn't even call the clearinghouses to see if the accounts actually existed. They closed the case every time. Markopolos spent years in fear, convinced that Madoff was a high-level criminal who might have him silenced. But the truth was simpler. The regulators were just too incompetent to see what was right in front of them. The crash that exposed everything. In 2008, the music stopped. The housing bubble burst, and the global markets began to melt down. Suddenly, every investor was terrified. Everyone needed cash at the same time. In a normal fund, you just sell your assets. But Bernie had no assets. He had a bank account at JP Morgan that was rapidly hitting zero. He needed $7 billion to cover the wave of withdrawals. He only had a few $100 million left. In a final, desperate act, he tried to raise money from his oldest friends, including 95-year-old philanthropist Carl Shapiro. The gas tank was empty. On December 10th, he confessed to his sons. The next morning, the FBI arrived at his penthouse. The king of Wall Street was led out in handcuffs, his empire vanishing in an instant. The human cost. The fallout was a graveyard of lives and legacies. This wasn't just about rich people losing extra money. The Elie Wiesel Foundation for Humanity, run by the Holocaust survivor and Nobel laureate, lost nearly everything, over $15 million. The greatest lie on Wall Street isn't that someone is cheating. It's the idea that someone has a sure thing. Because in the world of finance, if it looks too good to be true, it's not a miracle, it's a trap. And the next Madoff? He won't look like a villain. He'll look like a professional. He'll look exactly like someone you can trust. Because the most dangerous lies are the ones we desperately want to believe.